Good afternoon. This is Ash Heatwool, Director of Wealth Management at Graves Light Lenhart Wealth. In this update, we will speak to current economic trends, recent events, and themes for the past quarter, as well as our recommendations for current portfolio positioning for our clients. We will also address the importance of maintaining a long-term asset allocation or investment target, which allows for our clients to maximize their ability to stay invested through market cycles while, importantly, building their wealth over time. For those who wish to study this presentation in more detail, we have provided an associated link in the emailed client notification, which you can access and download for further analysis. As always, please let us know if you have any questions or if we can be of assistance. We are here to help. The slide in front of you provides asset class returns across various markets, both for the most recent March end quarter as well as during the month of March, showing the pullback observed as the war in Iran has caused a permeating effect across markets. As shown by the top red arrow, returns for the bellwether S&P 500 declined by 4.3% during the quarter, with the entire decline occurring during the month of March as geopolitical tensions in the Middle East generally caused risk-based assets such as stocks to sell off both domestically and abroad. Notably, there were significant dispersions seen within U.S. stocks during the first quarter as growth stocks, as represented by the S&P 500 Growth Index, declined by 8.1% during the quarter versus its counterpart, the S&P 500 Value Index, which was flat over the course of the full quarter. What caused this differential was notably the market showing greater discrimination towards U.S. growth stocks, which are investing unprecedented levels of capital investment into the artificial intelligence space. In addition, smaller cap domestic stocks generated positive returns during the quarter, while international stocks were modestly down but noticeably better than the S&P 500's results. Bonds, as shown by the Bloomberg Barclays Aggregate Bond Index, declined by 1.8% during the month of March due to higher concerns around inflation. Lastly, commodity returns were broadly positive as the closure of the Strait of Hormuz has created material supply issues within energy markets, ultimately causing oil and energy prices to spike during the first quarter. In aggregate, the Bloomberg Commodity Index increased 24.4% during the quarter, well outside its historical range. Geopolitical events, and specifically wars, are inherently challenging because of the severe consequences they often inflict on humanity. What the attached illustration shows is that while wars and regional conflicts often cause spikes in market volatility, their impact on portfolios has historically faded over time. We of course do not wish to diminish their negative impacts on humanity, but desire to show that negative impacts on the markets tend to be short-lived. No geopolitical situation or catastrophe is identical, but the broader view can often help clients maintain their posture while staying invested. In today's environment, the main mechanism between the war in Iran and the global economy is none other than oil prices, which can have both a direct and indirect impact on markets. To this extent, we are closely monitoring for the potential oil supply shocks, which raises concerns about the increasing inflationary pressures. In summary, war-related risks of this nature are impossible to predict, but we are not recommending making material changes to client portfolios as balanced allocations can be well equipped to navigate challenging markets such as this. These two charts are timely and provide a salient reminder on the nature of investing in financial securities. On the left-hand side of the page, we observe returns for the S&P 500 over the last 45 years. The gray bars represent full calendar year returns, with the red dots shown below reflecting the largest peak to trough drawdown or pullback during each calendar year. As you can see, sizable pullbacks or corrections often occur more than investors may recollect. On average, the intra-year decline of the S&P 500 has been a little over 14%. This is even though, in 35 of 46 years since 1980, returns for the calendar year ended up being positive. While the rapidity of any pullback may feel alarming, we impress the nature of allocating to stocks which invariably involves episodes of weakness. The chart on the right of the page shows the range of historical asset class returns over various time frames. Part of successful long-term investing is accepting that markets can experience a wide range of returns over a 12-month period. Our goal is to keep clients properly allocated over longer periods, which have shown a high propensity to achieve significant positive returns, dwarfing the few adverse outcomes of small declines or break-even results over various longer time frames. The key is time in the market, not timing the market. While not being an official forecast for gross domestic product or GDP, the Federal Reserve Bank of Atlanta provides a running estimate of real GDP growth based on available economic data for the current measured quarter. From our vantage point, it is one of several useful gauges for monitoring real-time changes in the U.S. economy. Per the most recent update from the Atlanta Fed, which as of April 9th, the estimated annualized growth rate of GDP has decelerated from its 2025 pace to a paltry plus 1.3% rate. On the top right-hand side of the slide, you can see how this trend appears relative to the last 7 months of 2025, reflecting the significant intra-year swings observed. On balance, and according to the U.S. Bureau of Economic Analysis, the full 2025 real GDP growth rate came in at a positive rate of 2.2%, primarily reflected by increases in consumer spending and capital investment. This being the case, and as indicated by the bold black brackets on the bottom right of the screen, personal consumer spending, which is also designated as personal consumption expenditures, or PCE, has experienced a slowdown in growth as the increased cost of living is taking a toll on many U.S. consumers. Stagflation is an economic condition in which stagnation of economic growth and inflation occur simultaneously, effectively meaning slow or negative economic growth, high unemployment, and rising prices all happen at the same time. The most famous episode of economic stagflation occurred in the 1970s, which was triggered largely by the 1973 OPEC oil embargo. In this environment, oil price shocks drove up the cost of living while also slowing economic activity. Both unemployment and inflation rose sharply. In short, this type of environment is bad across the board, hampering both one's standard of living while also being a challenging environment for most asset classes. As shown on the left side of the page, we use the misery index as a means to capture stagflation within the economy. The misery index is a simple and straightforward indicator which was created by economist Arthur Okun to best capture, in economic terms, how stressed the average person feels. It is simply a summation of both the unemployment rate and inflation. One can see that this gauge of discomfort peaked around 1980 when inflation was in the teens and unemployment was a high single-digit figure. Moreover, the misery index experienced twin peaks within a 10-year period as central bankers lowered interest rates too early. Fast forward to today, the misery index is tame by historical standards, but that is largely due to low unemployment. Inflation, while much more controlled versus the 1970s experience, remains an issue. Also of importance, and as represented on the right-hand side of the page, the share of energy goods and services as a percentage of consumer spending is significantly lower today when compared to the last 60 years. However, some of that lower percentage is due to lower oil prices over time. If current oil prices remain high, both recessionary and inflationary risks increase, even if 1970s style stagflation is unlikely to return given current conditions. In the short term, inflation news tends to negatively affect asset values. Once inflation sets in, it affects the forward returns of different assets in different ways. Certain categories of investment, such as value, assets considered low risk, and high-quality assets tend to be relatively resilient in inflationary regimes. For example, the factor premium, or excess return, of value investments in a high inflation regime is approximately 3.8% across equities, government bonds, and global assets. This is higher than in any other inflation regime. Asset allocation plays a crucial role in portfolio returns, and remaining invested allows for the possibility of earning the associated return premiums. Therefore, we believe our current asset allocation positioning remains appropriate to help to minimize corrosive inflationary headwinds over the intermediate to longer term. We often refer to the underlying earnings of a publicly traded business as the North Star of long-term investment returns. There are several prime drivers to long-term stock returns, which include underlying earnings, valuations, and dividends paid out of profits. Of these key drivers, valuations are near impossible to predict, as they are often predicated by the mood or sentiment of the markets. On the other hand, dividend payout rates and forward earnings expectations can be derived from various resources which can help construct a mosaic for return potential. While we do not attempt to predict short-term returns for stocks, which we believe to be a fool's errand, we pay close attention to all of these inputs. The two illustrations provided show that forward operating earnings for publicly traded stocks are on the rise, despite worries that soaring energy prices will weigh on future economic growth. While this has been the case for the S&P 500, which represents large-cap U.S. stocks, entering the year, we can also see an uptrend for forward earnings expectations for both mid-cap and small-cap stocks, which is encouraging to observe and plays out consistently with their relative returns to start 2026. On the right-hand side of the slide, we are tracking the forward earnings per share forecasts for MSCIEAFA, which represents an index of developed international stocks outside the U.S. While we observed some softness in forward estimates during the month of March due to higher energy dependence on Middle East sources by EAFA countries, earnings estimates are rising for these countries in aggregate as well, which bodes positively for the fundamentals of these businesses which trade outside of the U.S. stock market. Over the last 15 years, no country's stock market has thrived like that of the United States. Fueled by both fiscal and monetary stimulus at a time when many other countries were implementing austerity, the U.S. economy rebounded in the 2010s and continued with an AI-powered performance in the 2020s. However, such national equity dominance never lasts forever, even if predictions about timing are typically fruitless. The right strategy to deal with the uncertainty of the future, rather than chasing the returns of the past, is to hold a diverse portfolio. Holding an allocation in the equity markets of developed countries, as referenced by the EAFA index, serves a similar portfolio purpose as holding U.S. equities, but provides a stabilizing degree of diversification, both in terms of corporate exposure and the exchange-weighted value of the U.S. dollar. Further, given the significant historical run of the U.S. market, it remains relatively expensive, even after the recent declines in the S&P 500. The PE ratio of the EAFE index provides a 29% discount relative to the United States. Some of this discount is due to having different industry weights than the U.S., but even the technology companies in the EAFE are discounted relative to their U.S. counterparts. Buying solid companies at a discount, which helps to better absorb negative shocks, provides a fruitful long-term strategy for diversified wealth accumulation. Fixed income markets, also known as bonds, have had a volatile start to the year. Generally, interest rates have moved higher, irrespective of the specified maturity. Much of this has been due to the conflict in the Middle East, which has heightened concerns around inflation, which ultimately erodes the long-term purchasing power of a fixed income investment. However, amidst the volatility, opportunities can be presented as the interest one receives from holding a bond will reset at a higher level. The illustration on the slide shows the starting monthly yields for the Bloomberg U.S. Aggregate Index, a key benchmark for U.S. investment-grade bonds, on the horizontal axis since 1976. The vertical axis represents the 5-year annualized return for this index based on the entry yield level and shows a reasonably tight relationship between medium-term returns and the starting yield of this asset class. As of the end of March, the yield for the Bloomberg U.S. Aggregate Index was nearly 4.6%. For the multi-year investor, this provides a helpful indication for return expectations going forward. While not all bond markets are created equal, we continue to remind clients that a one-size-fits-all approach is inappropriate for bond investing. For example, the level of compensation for default risk in lower-quality bond markets continues to be inadequate, directing our emphasis to a high-quality or investment-grade bias for bond positioning. Moreover, we continue to see signs of stress in the private credit market where recent client redemptions have been gated or prevented when investors have attempted to sell their positions. For reasons of illiquidity, opacity, and high embedded costs, we have not directed client funds to private credit investment structures. We believe the associated issues have been largely contained to the private credit market, and are not anticipated to spread through the banking/financial system at large given known exposures. Nonetheless, we believe the risk of contagion from strains related to the private credit market and the expanded universe of funding sources of this market necessitate close monitoring. This concludes our presentation for the second quarter of 2026. Thank you for listening.